There we go. All right, welcome. I'm glad you all are here. Again, I am Steve Papale, and today is our Monday mentoring session. And today we are going to talk a little bit about butterflies, the world of butterflies. Specifically, we're going to go into what we call the broken wing butterfly. This is something that we don't really cover a whole lot in our program. We tend to go with the traditional butterfly, but there seems to be some interest in these broken wing ones. So I thought what I would do is go over these. We're also going to kind of review the regular butterfly too. So anyway, for those of you that haven't been on the webinar, and for just as a refresher for the folks that do come on here, today I'm gonna kind of go back and forth between PowerPoint and Matrix or my screen, my desktop, and we'll model out a couple of butterflies. So there will be times when I won't actually be able to see the desktop. If you have any questions, audio's bad. Hopefully the audio. I don't know what I can do on the audio. You may want to try to adjust your own audio. Is anybody else having bad audio? Because I am working off of Bluetooth, and it helps me just keep my hands free. But if we're getting universally bad audio, okay, it looks like maybe people are getting okay audio. I'm going to stick with the Bluetooth. If a lot of people are getting bad audio, then it's maybe on my side, and then I would pull it. But it makes it a little easier for me to maneuver. If you got questions, I'd like this to be as informal as we possibly can make it, considering we're on a computer and I'm talking to a box here and I can't hear anybody, but I can see the chats. So if you got a question or a comment, shoot it in anytime. I will get to it pretty much when I see it. So we'll try to address any of these questions as they come up. The only time, like I said, is when I go onto my desktop, when I actually get into the modeling, into the matrix and the software, all I can see is the software, so I won't be able to see any questions at that point. But then when I come back, I'll check them out. So anyway, that's it. We'll get going. Hopefully have some fun, learn a little thing, a little about butterflies, and kind of moving on. I'll try to get this thing within an hour, so I don't think that would be a problem at all. Real quickly, Papale Capital Management is a registered investment advisor. Discover Options is an option education provider. Everything I do today is purely for information and educational purposes only, and I'm not here to try to drum up any kind of business for mine or investment business or any of that kind of thing. Consult your advisors and et cetera, et cetera. All right, I am always glad to be here. I love doing these things. I wish I could hear people. That's the only bad thing. I wish they had some sort of thing where I could hear everybody. But anyway, I'm glad to be here. And of course, me being from Chicago, we're riding high right now after our Blackhawks have pulled Game 2 in the Western Conference Finals for the NHL. I don't know if anybody else there's from LA, but my sympathies are with you, I suppose. Anyway, it's not over yet. I know that, but I know we're off to LA now. So, but we're feeling pretty good. I'm feeling pretty good. So, I love hockey. I love watching it. I like to play it, but I'm not very good. My son is much better than me. So, it's good for my ankles, though. I can't play basketball anymore. My ankles take too much of a beating. So, all right. What we're going to do is I'm going to talk a little bit about a butterfly, a standard butterfly. I'm not going to spend a whole bunch of time going over it. I'll just sort of review it. We'll go over it sort of quickly, more as a point of reference than anything else. If you do have a question about it, feel free to jump in. We'll model one out. We'll kind of show what it looks like. Just a traditional standard, what I would call standard butterfly, equidistant legs. It's a typical thing. We teach it here. If you ever read a textbook on butterflies, this is pretty much what you're going to see is a typical standard butterfly. Then what I'm going to do is I'm going to jump back to the PowerPoint, after we model it, and then we're going to kind of go over a broken wing and some of the issues and the talking points on a broken wing, some of the differences between the two. And the broken wing is actually kind of a cool thing. So, but again, just like anything that we do in options, every strategy has its advantages and then its offsetting risk. There is no perfect strategy. So while the broken wing has certain advantages that we'll point out, there's some trade-offs in terms of risk management. So you'll see those too. But all in all, it could work good, especially for the folks that do directional trading or have a specific, maybe a target, a price target that they're looking at. The broken wing is a pretty slick strategy. All right. The standard butterfly, the traditional butterfly, it's generally a market range bound expectation strategy. Okay. Usually when we set up a butterfly, you know, we kind of say, okay, well, we sort of usually do it right at the market. It's the market today, the spoofs are sitting around, I think around 16.25. We'll see here in a second. I'll bring the software up. But usually that's when we place the body of the butterfly, the short strikes, and then we kind of set the other ones, the long strikes around that, and we look for the market to kind of stay within a given range. That's what makes the butterfly work. It is a theta collecting strategy, okay? The two options that we're short are generally closer to the at the money than the two long options. Those two short options, because they are closer to at the money, have greater rate of time decay than the other two. So basically, that's a big way of how we make our money on the butterfly. We might make it on a volatility move because it is short Vega for the most part, but we don't really, you know, that can either work for us or against us. Theta is the way we make our money in the butterfly. It's theta. And the opposite side of the coin of theta, the risk side of the coin of theta, if you're an option seller, is gamma, negative gamma. And we don't want that thing to move around. If we're negative gamma and the thing starts flying around one way or the other, of course, that's going to hurt us. So we want this thing to stay range bound. We want it to sit right here and just erode, and we collect theta, and everybody's happy. That's what we want. Okay. We're going to talk a little bit about the call butterfly. That's the one I'll model out, at least for the standard butterfly. But just know that you can use a call butterfly, you can do a put butterfly, you can do an iron butterfly. They're all the same. In terms of price performance, there is no difference. And when you price out the call and the put butterfly at the same strikes, you're going to have the same pricing. When you do an iron butterfly, okay, it's a credit butterfly. But in terms of the price performance, again, it's the same trade. I know there's a lot of dialogue that we've had in the past here at Discover Options and amongst all of us and in students, certain advantages of trading, you know, iron fly, call fly, whatever. Theoretically, there's no difference. I tend to go with call just because it seems like everyone knows call butterflies. They're just the most quoted, I think, butterfly out there. But if you like iron fly, you know, trade the iron fly. If you can get the fills, then it's the same. It's just as well as any of them. So, all right. Here's the structure of the call fly. If you look up top here, you can see you're buying one in the money. Okay, in this case, an in the money call. Then you would sell two at the money or center, center calls. Okay, you can shift this thing necessarily. It doesn't have to be right at the money necessarily, but you have two center options that you're selling and then one out of the money call. Effectively, you're long one in the money call spread, okay, and you're short one out of the money call spread. That is really the structure of the butterfly itself. The strikes are always equidistant, If I'm doing 10 points on the downside, I'm doing 10 points on the upside. It's a debit spread, okay? The call butterfly, the put butterfly, they're both debit spreads. The further apart the strikes, the greater the debit, okay? The further apart the strikes, the greater the debit, but the greater the profit range, okay? And I say that because the debit goes up fairly consistently. The profit range doesn't seem to go up quite as quickly, and that's just the way the thing is structured. It's kind of a triangle, and you spread the legs out. They don't seem to go out quite as much as the debit does, but that's how it works. That's a relationship. And just as a point of review here, there is no difference in price performance for a call butterfly, a put butterfly, or an iron butterfly. It is the same trade. It is the same amount of dollars. When we talk about debit spreads and margin, I use them interchangeably. Okay, if I pay $7 for a call butterfly, okay, I could pay $7 for a put butterfly, and I could do a $10 iron butterfly for a credit of $3, for example. Okay. Effectively, what I do is I have a gross margin of $10 that I have to post, but I've collected $3 for that iron fly. So the amount of money that I have to put up in margin becomes $7, which happens to be the same amount of money as I have to put up for my debit spread. So if you work the math out between these credit spreads and these debit spreads, they all come out to the same. Okay. There might be a little bit of noise, a little movement, but they're all pretty much going to be the same. Okay. I think that's it. Okay, the Greeks real quick. Standard fly, short Vega. Okay. It's long theta. Again, we collect the time decay. It's delta neutral kind of, and I say kind of because there's a vertical skew in these markets, and we'll see that here in a second. And because of the vertical skew, meaning the puts trade at a higher implied volatility than the calls, because of that skew, you're going to have a little delta skew, and it causes the butterflies in equities to be negative delta, okay? And they are short gamma. These are short gamma. So what I'm going to do right now is I'm going to share my desktop. I'm going to hope that you all can see my desktop when I do this, and this is only going to take about 5 minutes, and maybe less than that even. But I'm just going to model out the standard butterfly as a point of reference, okay? So I'm going to go over here, I'm going to share my desktop, and you'll be able to go and see. There we go. You should see my OptionVue quote screen here, and I'm hopeful that everybody can see that. And what I'm going to do right now is I'm going to go into the SPX, and I'm going to open the matrix up, and here we are on the SPX. And right here you can see that the market's sitting at 1630. Whoop, we're getting all kinds of weirdness going on here. It's always an adventure when I'm dealing with technology on my laptop. There we go. Because oftentimes when we're dealing with the desktop sharing, when I do these webinars, we get some stickiness for some strange reason in the viewing, but kind of bear with me. We're at 1630 on the at the money. I'm going to go over here and I'm going to just quickly, well, we're missing some prices here. I don't know why. But I'm going to model out a couple. I'm just going to model out a simple, standard butterfly, just a real easy, basic butterfly. We're going to go, let's see. We'll leave the short strike here at the money. And I'll go 1, 2, 3, 4 strikes down to 1610. Okay, so that's 20 points. And then I'll move it up to the 1650. And there we go. We got one butterfly. It's costing me 180 bucks. Okay, that's just the math basically that I would have to pay out if I sold 2 of these at 33.60, bought one of these at 22.90, and bought one of these at 46.10. We're live here. The markets are live, so things are ticking a little bit. But there's our butterfly. You can see here we're short a little delta, okay, and I only did one lot, so it's kind of hard to see this, but you can see that we're short some delta, okay, and again, that's this vertical skew here. Here's the at-the-money implied volatility, 14.2. You can see as we go out here, we're at 14.9, higher implied volatility. If you go up to the call here, the out-of-the-money call, you can see we're at 13.5. So there's that vertical skew. That is what drives this delta and makes it so it's not zero. We're short a little gamma. Again, negative gamma because we're short these two at the money. There's our theta. We're collecting a whopping $2.60 a day. But remember, we're only doing one butterfly here, only modeled one lot. And there's our Vega. We're short 13 bucks a Vega. So implied volatility goes up 1%. Our butterfly will theoretically lose $13.28 of value. Okay? And then again, the model, the analysis is this. Okay, here we go. I'm going to get rid of a bunch of these lines because it's a little bit confusing. We'll just keep it here. This is our profit, our maximum profit point right here. Okay, right at the short strike, right at the 1630 is our peak. Okay, that's our maximum profit. The most we can lose is our debit. Okay, the debit or whatever we paid for it, which is about 180 bucks or whatever it was. You can see that out here, that's this. Right there. That's the most we can lose. Okay, what's the most we can make? The most we can make is the difference between these strikes right here. So we did 20 points, I think, right here. Okay, so we make 2,000. Okay, the most we can make is the 2,000, or the difference between the strikes, less what we paid for it. Okay, so we paid about 200 bucks. So this is sitting here right about 1,800 bucks or so. Okay, and one real easy way to think about this is this: when you're dealing with these butterflies, they're always equidistant. So if we've got a 20-point butterfly, remember what's the best. The max profit is always at the short strike. Why does that work intuitively? Well, we're long right here, the 1610, 1630 call spread. If it settles at 1630, that call spread goes out its maximum value, which happens to be 20 bucks. We're also short the 1630, 1650 call spread. Okay? If it goes out at 1630, that call spread that we're short goes out at zero. So we make 20 bucks on our long, which is the maximum. Our short goes out as worthless. So we keep full 20 bucks. Okay? Of course, we paid 200 bucks or whatever, so that's going to come off the top. But that's how you get it, intuitive. So think of it like that when you're trying to figure out your max. You don't even need the curve here. You can just think of it in that perspective. But anyway, you can see that the debit along the bottom here is consistent. If we go too far out, we can only lose, no matter what, the 180 or the 200 or whatever we paid for this fly. Very standard, equidistant, relying on time decay. So as we add lines here, you can see that you can see as we go over time, our profitability will start to inch up, and it'll start to fit to this curve very, very closely as we add more and more and more lines. And these are all the Greeks down here, and it just moves along the price range. So this is a standard butterfly. And I'm going to go back to the screen and just see if anybody has any questions on any of this. But very traditional, very typical call butterfly. So I'm going to now attempt to go back to the regular screen, and there we go. I'm back. All right. Hopefully that everybody saw that. I hope so. I did that one time, believe it or not. Maybe not. Maybe it's not hard to believe. I did that one time, and for some reason, nobody could see my desktop. So hopefully, everyone did see that. But that's a typical standard butterfly. All right. If there are no questions on the standard, and I don't see any coming in, I'm going to jump over to the broken wing here, and we'll get into that here. So I think I'm going to jump into the broken wing. There we go. Oh yeah, this is left over from the standard. I guess I should have done this before I did it. The maximum profit of the standard butterfly, in fact, all butterflies, is at the short strike. Okay, we know that. The profit is the difference between the strikes less the debit. Okay, we showed that in this 20-point butterfly. We showed how that worked. And again, in all these butterflies, these debit flies, the max loss is the debit. So if you pay 200 bucks for a fly, the most you're going to lose is $200. Doesn't matter. The mark can go to zero. The mark can go to infinity. All you can lose is your 200. Okay. All right. Oh man, okay, I forgot. I guess I got this one too. We set this butterfly up at the money, the short strike being at the money. You can move these up and down, obviously. Okay, if you happen to think that the market's going to go to 650 or whatever, you can still set that equidistant standard butterfly above the market. Okay, or you could even do it below the market. So you can move these things and shift them. It's best, in my opinion, to run these as a bullish trade. So if you're bullish, putting a butterfly above the market makes some sense because you are short Vega, and generally when the markets rally, implied volatility comes in, it goes down. So if we're being short Vega, that gives us a little advantage. We might be able to catch a little extra profit. The vertical skew will affect the delta, like we said, like we shown. That's not as good, like we illustrated. You can adjust that delta in a couple of different ways. You can either buy some extra deltas outright by, maybe buying some calls, or you can slide the butterfly up a strike. If you push the butterfly up, the delta will get less negative. Okay. And there's a reason. I won't get into why. What you may want to lean a little short delta generally on these flies. We get into that in the program a little bit, but either way, if you do want to flatten that delta up, those are the ways I would recommend you can do them. And no legging. I've seen guys try to leg into these flies. You got 3 different strikes, and they're figuring they're going to try to buy them individually. That can be a very good way to get into a butterfly, or a very bad way to get into a butterfly. But it's always a very risky way to get into a butterfly. I would not advocate it. You can get some really good tight markets on these flies. Forget about what you're seeing on your screen. Those are all what they call natural markets. When you quote butterflies, you get a much tighter market. Okay. We're going to do the 60-day time, I think. We're going to look up into July for the butterfly modeling. There's only 18 days left in June, so I'm going to look at July. Generally, as far as butterflies are concerned, I don't like to go more than 60 days. We generally go closer in on that in our program, but theta is a big component of what we're doing here. And as you go further out in time, that decay curve starts to get a little flat, and you really are operating in a low time decay environment when you go too far out. So we try to keep it within 30 to 60. All right, here we are, broken wing butter. I don't know if you guys can see, that's a butterfly with a broken wing. So surgery needed. All right, how does it fly? Again, the broken wing, what that means is it is unbalanced between strikes. Like the standard butterfly is 20 points. We did a 20-point butterfly, so we were equidistant on the in-the-money call and equidistant to the out-of-the-money call. The broken wing is different. It has a different distance between the strikes. you can think of this as a risk shift strategy. Okay, what that means is you're shifting all the risk from one side of the butterfly to the other. So effectively, one side of your butterfly will have no risk, zero risk. The other side, however, will have a lot more risk. Okay, this is a cool strategy if you're a directional trader. Okay, or if you have concerns the market, you know, could do something goofy in one side. Okay, if you're worried about a sell-off, this could be a good trade for you to put on. Or if you're really worried about a huge rally, this could be a good trade for you to put on. This is a trade that can be done for very low cost or even a credit. Okay, it is still a theta collecting strategy generally. Okay, again, theta depends on how close your strikes are to the at the money. Okay, it's all a function of your long strikes, your short strikes, and which ones are closer or further away from the at the money, and it does the math and it determines if you're making it or losing it. Generally, these things still you are theta collecting, but depending how far away you set this thing up, it could be the other way around too. You can use calls or puts. You can use calls or puts, and we can model these out both ways. So you can use it as a call butterfly or a put butterfly. Here's the structure. Again, it's a butterfly. So you got one in the money, two at the money, and one out of the money. In these things, the out of the money is further away. Okay, hence it's unbalanced. Okay, what we're really doing with these things at the end of the day is we are selling and I'm going to start out right now by talking in terms of the call butterfly. Okay. Effectively, what we're really doing at the end of the day is we're selling a call spread. Okay, you've got a call butterfly, a standard call butterfly. What we're going to do is we're going to go to the out of the money call and we're going to sell a call spread. We're going to sell the call that we're long, and we're going to buy another call further out of the money. That is basically selling a call spread. When we sell that call spread, we get a credit. That is what allows us to turn a debit butterfly into a lower debit or even a credit butterfly. Now, the problem is when you sell a call spread, you got risk. If I'm going to sell a call spread, I got risk up there, depending on how wide of my call spread I'm selling. So what I've effectively done is I've created greater risk in that direction. Okay? What I've also done is eliminated risk on the other side. All right? And we'll show that here in a second. Okay. The other issue you have when you're doing these broken wing butterflies is because they're not equidistant, you have greater margin. So keep that in mind. Even though we are getting a credit sometimes, and hopefully I can model this out so we can get it as a credit, you're going to have to put up more margin. That's just how it goes. So you're going to have more money in the account to do the trade. Broken wing Greeks, short Vega, and I got all these generalities and usuallys and depends in here. Because so much of it depends a lot on how far you're setting your strikes, where you are relative to the at the money. Those are the two things that will dictate your Greeks. So short Vega, generally. We're generally short Vega. Long theta, usually. Delta depends. I sound like somebody on a stand or something in trial. Depends. Short gamma, mostly. So very ambiguous, but these are generally, you're going to find the Greeks are going to be the same as a regular butterfly. Okay. P&L, again, like all spreads, all butterflies, the max profit is at the short strike. You want to have this thing sitting right at your short strike at expiration. The maximum profit is going to be the difference between the lower strike, in the case of the call butterfly, and the center strike, okay, plus or minus the debit or the credit. Okay, so it's the P&L is the same as a standard butterfly, but it's based on the lower call to the midpoint there. The maximum loss is just the width of the extended call spread, plus or minus the debit or the credit. So if we effectively extend the strike, the call out one strike in the SPX, for example, that's like a $5 call spread. So that's $500. We just got to put up the extra margin. So that's your max loss. Is that okay? Then if you get a credit, that'll offset it a little bit. All right. And then finally here, a higher margin, like we said, than the traditional fly. I'm not sure if I should. I'll say this now. Thinking maybe I should do this after. It works best on slow-moving markets. All these butterflies do better in markets that just slow. Time has to work for you. Unless you get a huge volatility down move, you're not going to. These butterflies need time. Their time decay is how we're making our money. If you got these directional broken wing butterflies, and I'll show this, you could be right, but if you're too right, what I mean by that is if you get to your target point tomorrow, you're going to be in trouble. You need time. It needs to move slowly in that direction. You can use these broken wing butterflies if you're worried about downside risk. In the case of a call butterfly, if you're worried about downside risk, you can use a put broken wing butterfly if you're worried about upside risk. And oh yeah, we may be able to buy back a call spread or a put spread to lock in a profit and shut down directional risk. I'll show that. Effectively, what you're doing when you set these flies up is you sell the call spread to establish the broken wing butterfly, like what we said. Okay. Eventually, in the right market conditions, what you could do is turn around and buy it back later, convert it back to a standard butterfly, and if you can do that in a profitable price, you can effectively lock in a small profit or a profit, and no matter what the market does, you kind of lock in some profits. So that's kind of cool. I'll show that. I'll wait until. All right, I'm going to go back. Everybody did see my software, right? Before we didn't have any problems with the viewing, because I'm going to jump on here now. And I'm going to spend probably about 15 minutes on this software. So if I didn't show it, please say it. Otherwise, I'm going to go over right now and spend the next 10 or 15 minutes just modeling out a couple of broken wing butterflies. All right, I guess we're good. So here we go. I'm going to view it, and I'm going to share my desktop again. And let's see what the market's up to here. Okay, here we go. We're back. And there is the SPX. Here was our other fly. I'm going to just get rid of this, clear this out. All right. Again, I'm going to use the SPX. You can do this with anything. You can do this with an ETF. You can do this with a stock. You can do this with commodity. Keep in mind that when you're dealing with commodities, you got different kind of vertical skew. You got different issues with each particular underlying that you're doing stuff with. So know what you're trading and how that all works. But I'll play around here in the SPX just because I used to be in the SPX. So I like the SPX. All right, here we are. We're at the money, 1630 at the money. I'm going to do July again. We could do June, but there's only 18 days. And when you start getting too close to expiration, sometimes the Greeks get a little funky. So let's just go to July. In 46 days for something like this is totally fine. That's totally a good amount of time. All right, I'm just going to pretend that I'm a guy who who believes that the market's going to go up. And I'm going to say we have, let's just say we're going to go to the say 1660 is my target. Okay. So like any butterfly, I'm going to set my short strike at my target. Okay. 1660. Okay. What I'll do is, this is the SPX. Again, now this is where it gets to be a little bit up to discretion. You could set these butterflies up one strike, apart, two strikes apart, 3, 4, 5, whatever it is. SPX is a big index. There's a whole bunch of strikes. There's a lot of premium. So we could set this thing up gigantically, but I'll just pick this. I'll just make it a 3 strike on the lower leg. Okay, so my in the money call, actually it's not in the money, it's out of the money, but my in the money call relative to the butterfly is going to be the 1645. Okay, it's a 15-pointer. Now, let me see, 1, 2, 3. This would be what I would be doing if I did a standard butterfly. Okay, there it is. Remember, I said you could set the standard butterfly up, up here. It's going to cost you less than if you set at the money. You could, or at the money one before was $200 or $190. It's only $140. Okay, and again, we've got, these are Greeks. This is our standard. But here's what we're going to do. Okay, we're gonna shift this thing up 1 strike. Okay, we're going to sell this call spread 1 time. Okay, what that means is I'm going to sell this 1 lot, I'm going to buy the other 1 lot. So I'm going to get rid of this and I'm going to buy this. Okay, we have now created a broken wing butterfly. I'm doing this for a credit now. Okay, I got a credit overall because I sold that call spread. All right. The gross requirement here, this margin, remember I said that the risk was going to be the difference of the number of the strike. I've sold a $5 call spread. I need to put up $500 of margin to be short a $5 call spread in the SPX. And there you have it. There's my $500 I had to post. I did receive $20 though for the credit of the call spread. Okay, overall. So I only got to put up $480 basically. All right. Here's our Greeks. We're still short delta. Okay, we're short some gamma. We're still collecting a little bit of theta, and we're short Vega. So the Greeks are the same as a standard butterfly. Okay. So let's take a look at the analyzed graph. Okay, for those of you that have seen it. Oh boy, what a mess. Let me get rid of some of these lines. I'll try to make it a little clearer to see. Here's what we have. All right, I'm going to click on this, try to make it easy to read here. Again, here's our short strike. Okay, we're at the 1660 is the short strike. That's going to be our max profit. Okay, and it was a $15. Remember how to calculate that max profit? It was the distance between here's our trade right up here, so we're gonna have to keep going back and forth. It was the difference between that lower leg and that center strike, which is 15 points. Okay, or $1,500 is our max profit, plus or minus the credit or debit. So we got $20. So the max profit on this thing is actually going to be around $1,520. You can see it's right here. It's just a tiny bit over $1,500. Okay. And the most we can lose is that $480. Remember, we had that $500 margin, or that call spread that we had. We're essentially short a call spread on the a $5 call spread up top there. The markup blows straight up. We're going to lose that money, that $5 call spread that we're short. Well, we collect a 20, so the most we're going to lose is $480. But this is kind of interesting because if you're wrong, if you're totally wrong and the market sells up tomorrow, we're going to make $20 at expiration. Okay. But again, like with everything, it's a risk shift. You can see that the risk is shifted from the downside to more risk on the upside. You got, and here's what I was pointing out. If we get to your target tomorrow, we're sitting at 1630 right now. If we get to our target tomorrow, that's no good, because we're going to be right here where my arrow is on this dotted line right here. This dotted line represents what the model is projecting our position to do today under these price movements. Okay, given everything, given the implied volatility and all the inputs we have today, this dotted line that my pointer's on, let me just get rid of it. There. That is going to show what the market's going to do today, how it's going to perform. You can see that we can be right, but guess what? We're still going to lose money. And that's because we haven't allowed time decay to do its job. The only way this trade is going to make money for us is if it grinds very, very slowly up into this space. And that's when we get to make our money. Okay. And you can see certainly if we overshoot where we're going to have a problem too. So this is a trade where, you know, you can, obviously on the downside, you don't have any risk, but if it does overshoot on the upside, you know, there's going to be some adjustments that you're probably going to want to make. So that is the call butterfly. It's kind of a cool thing. If you're nervous about downside risk, this is pretty slick. I'm going to close this, and what I'm going to do, I'm going to show you one little thing here, and then we'll jump onto the put. And we're showing $70 here of cash flow right now. Obviously, this thing is moving all over creation, but theoretically, I have sold this call spread. Okay, I've sold this call spread for, you know, $2, whatever it is. And I've taken in this overall cash flow of $70. All right. If at expiration or prior to expiration, the market goes down, it does whatever, and I can buy this call spread back, okay? So effectively what I would do is sell these 1680s and buy these 1675 calls back. If I could do that for less than whatever this credit is, I effectively can lock down my position for no risk. And let me just do that. There's not a lot of credit right now, so I'm going to play around with the numbers. I mean, if you were to do bigger strikes, you could do it. I mean, I could do it. Let me try something here. See if this is going to give me more of a credit, but more risk. Okay, you can see my credit went up, but so did my margin, because now I got a $10 call spread. So let's pretend real quickly that we did this trade. Okay, so I took in like $200 or whatever. There it is. Okay, our cash flow is 200. Okay, you can see our profitability is all here. Okay, if we go up here, we're going to do fine, but then we got this risk down here. Now, say that, let me see, say that, say we're going on and it's whatever, the market sold off or it's just drifted down, didn't do a whole lot. What I could do is I could turn around and buy that call spread back. Okay, just do this and then do this. Okay, what is that going to do? That's going to turn us back into our original butterfly, a standard butterfly. Okay, now here's the rub though. Here's the kind of the thing. I'm going to convert this trade. Okay, and I did this for like $2 or whatever. I'm going to convert the trade over. Okay, and you can see that I've basically just converted it to a standard. The key is if I can do that for less than that credit, and whoops, I'm going to force these prices into something different, just to show how that would look. Okay. There. If I can buy that call spread for less than what I did that credit for, so if I take in 200 bucks, okay, and I turn around and the market sells off, and suddenly I can buy that call spread for 100 bucks. I spend $100 on my profit. I then turn around and buy that call spread back. What I've effectively done is locked down I've locked in my profit and allowed me to have no risk no matter what the market does, and still allow me to profit if it gets to my short strike. Okay? So it eliminated all this upside risk that I had, and it still allowed me to profit if I get to my target. So that's another option. You don't have to do that because you got to spend a little bit of your profits in getting there. But if the market does move, you don't have, and you want to eliminate all this upside risk. That could be something you could, that could be kind of cool. So that's an adjustment, just one type of adjustment that you could do. All right, I'm going to go over here and I'm going to model out what is this, sluggish? Wow. Clear. Oh, wait, no, I know why that's not, whoops. I'm going to eliminate it. I'm just going to get rid of all these trades, just the easy way. I'm clear the trades. Those are all our call trades. They're gone. I'm just going to model out a put butter here. This is the same. This is if you're worried about an upside. Say you got a downside target. Okay, you're bearish. Again, the SPUs are rally mode here a little bit. We're at 1630 roughly. You're bearish, and say you're looking for, I don't know, 1590 or something like that is your target. So you sell 2, and then again you go on the puts. It's the opposite. So I would have my deeper put above here. Okay, so I one lot here. I'll do 3 again just because I'll stick with that. You could do a 2 or 4, whatever. Again, this is going to be standard butterfly, 80 bucks. Okay, standard looking. There's our delta, our gamma showing pretty close to 0, theta, Vega. There's your standard butterfly. So what I'll do is I will go on this put spread, and I'm going to sell the put spread in this case. So I'm going to move this baby down from there to there. There we go. So now we get a $40 credit. Same deal with the call spread now as far as margin is concerned. I've sold a $5 put spread, so I've got the post margin. But since I've got a credit of 40 bucks, I only got to put up to 460. All right. The analyze button here we go. So this is the case where I'm looking for a downside move, but if I'm completely wrong, I'm not going to be hurt. I got a flat curve on the upside. Okay. But I've got the double risk deal here on the downside. Okay. Same max profit point, my short strike. Okay. It's a 15 point. Remember from the in the money put, which is this put right here, the 1605 to the 1590 is a $15 put spread. That's our max profit, plus or minus the credit. So 1500 plus or minus the 40 bucks, which gives us, it'll be right here at like 1540 or whatever is what we've maxed out at. Okay. The risk, again, that extra put spread, 500 bucks plus or minus the credit. So we got 40 bucks, so we're looking at 460. Same kind of dynamic as the call spread. If you get to your target, if it sells off tomorrow, you're going to be wrong, even though you were very right. Your P&L is going to be wrong, let me put it that way. This is the strategy that requires time. If I start adding lines, this one line right here represents what the model is saying this thing will perform today. If I add another line, I've got 23 days from now. You can see it up here now. That's this line. It's closer to the 0 point. If I add another line, now I can see what it's going to do in 31 days. And you can see now it's starting to kind of creep up here. If I have another line, well, close that. I'm getting fills here. If I have another line, then eventually it starts to kind of blend in with this parity curve. The point is, these require time. They require time. Okay. All right, and the same idea here, real quickly. I'll wrap this up. The same idea for the adjustment is you've taken the credit in. If the market goes up or does whatever, and you can somehow buy the put spread back for less than what that credit was, you can effectively lock down your risk and let the market do whatever it wants to do and not have to worry. Anyway, pretty cool. I'm going to go back to the chat area and see if anybody has any questions. All right. All right, we got a question. Joe, what do you think of doing broken wing butterflies in the weeklies for quick theta decay? I get a lot of questions on the weeklies, and the weeklies are like, what's the most popular thing people are watching? Reality TV. Weeklies are like reality TV of options trading now. Everybody's interested in them. A lot of people are trading them. They're very popular. In fact, I think they're the most popular option being traded today. The problem with the weeklies, the good and the bad in the weeklies is this: the decay is much quicker, but the gamma is much steeper. So if you can get any kind of option that has enough premium to pay you time decay, which is of course how we want to get paid, you're going to have an awful lot of gamma. So my recommendation on weeklies is always trade them if you want, but make sure you understand the risk that's involved in them, because these things can turn very quickly. What I mean by that is the gammas can be very steep, and the P&Ls can really fly around a lot. The Greeks can change incredibly fast. The other thing is that when you only have a week to go to expiration, it tends to limit the selection that you have as far as strikes are concerned. So, you know, a lot of the out-of-the-money stuff is at 0, so you don't have a whole lot to do with those strikes. So you're going to limit, oftentimes, how you're going to structure the trade. Statistically, it's going to be the same. I mean, if you're using any kind of statistics to set your distances, the standard deviations and all are the same. The difference is one's 46 days and one is 5 days. But practically, from application point, you're going to have a little tougher time in choosing strikes. So, but great question. People are always trying to figure out how to do the weeklies, and I know guys that do okay with weeklies. Do you pay attention to the expected return and profit potential? I do not. I'm sure if somebody from Discover Options was listening, they'd be maybe sad to hear that, but I don't. I think for certain statistical-based trades, the PP and the expected return is important. I don't look at that really. I look purely at where I use statistics occasionally to set up a trade, but I don't look at those two numbers very often. They can move around a little bit, and expected return has a lot more to do with movement along a price range that we cover risk before it even hits to the second standard deviation. So I generally don't let things run that wild. So, but I know guys that, again, it's a measure that a lot of guys use. I think we talked about this slide. Let me jump to the next one. I think I got just a couple of minor concluding remarks here. Broken wing butterflies, like all option strategies, have risk-reward trade-offs. We saw that. Okay, this is basically a risk shift strategy. You really haven't. I don't think you've really gotten rid of any risk. You've just moved it from one side of the butterfly to the other, one side of the curve to the other. Standard and broken butterflies reach their max profit at the short strike. That's always the case. So always set that short strike where you feel that you would expect the market to go, or if you're like me that have no idea where the market's going, you may just use the market where it is today. And then time works to the advantage in both. So theta is how these butterflies are going to make their money no matter how you set it up, unless you just do some so monstrously out of the money option that they're butterfly that it's way out there. We're really looking at theta here. So watch the theta, manage the fly, manage those Greeks. As you go further out in time, the Greeks will move slower. It'll be a slower adjustment issue with you, or with, not with you, but with the butterfly. As you get closer and closer to the expiration, you know, the Greeks tend to get a little more volatile. And what I mean, Greeks that are closer to at the money tend to get a little more active. So requires a little more paying attention. So obviously the weeklies will be the extreme case of that. Okay. If you got anybody I'll stick around for any more questions. I know it's 2 o'clock. I always try to wrap this up, you know, on time, but I'm here. If anybody has any more questions, I'm happy to stay. This is my information. If you have any further questions, please let me know. I'm happy to answer any emails or phone calls. And I think that is what I have. So I will look on the chat box and see if I missed. I don't think I missed any. Great to have you all here. I appreciate it. If anybody's got any recommendations for topics, I'm usually here about every 3 weeks or so. So if there's somebody else that folks want to hear, shoot me an email. I will make sure that I get it, and we'll cover it. So, all right, go Blackhawks. I think it's going to be Blackhawks and Bruins, maybe. Huh? Although I went right off the Penguins just yet, but more the Kings for that matter. All right, folks. Well, if there is no more questions, I will sign off. Again, thank you all for being here. It's been a pleasure. And I would say enjoy the rest of your day. Take care.